Hi everyone, I'm Juliana.
And I'm Miles. In this video, we'll talk about some of the common pitfalls when investing.
Today, we'll be talking about some of the common mistakes people make when investing. We hope being conscious of these mistakes will help you avoid them over the course of your life. And I'm not just referring to younger and newer investors, I'm talking about experienced investors as well.
Wait, you mean everyone can experience these mistakes and risks? I thought the rule of thumb for investing was buy low and sell high.
Ah yes, the notion of buying investments when their price is at their lowest point and selling them when their price is peaked. Sounds simple, right? Wrong. If it were that easy, everyone would be rich and I'd be able to go on my dream vacation all around Europe.
And I'd probably be retired on an island somewhere in the Caribbean.
But unless you have a crystal ball, predicting the market isn't so simple. Depending on what you're invested in, securities can be quite volatile and go up and down very quickly, just like a roller coaster ride. This can be pretty stressful for investors and work up a whole range of emotions, from satisfaction to great disappointment.
This introduces the added layer of our emotions and feelings about our investing decisions, which can cloud our judgment. That can lead to errors being made like pulling out of the stock market and locking in losses during periods of market stress until things calm down.
How your emotions and feelings come into play when you invest is what behavioral finance is all about. How would you describe that topic?
Behavioral finance studies the relationship between behavioral psychology, the science of mind and behavior, and finance, and helps explain why people make irrational financial decisions. One example study in behavioral finance is overconfidence. Investors may believe they can try to time when to get in and out of the markets.
Just as I mentioned earlier, without a crystal ball, it's very difficult to time the market, and even more difficult to do it consistently. How do you know when markets are at the top or when they're bottoming? Simply, you don't. As an investor, one of the first things you need to accept is that you will not be able to pinpoint the exact highs and lows, and that trying to time the market is not a successful investment strategy.
Got it. So let's say I have $1,000 to invest. How can I put that to work?
That's a great question. Let me introduce you to the concepts of lump sum investing and dollar cost averaging. There are pros and cons to both approaches. The main difference between the two is when you invest in the market. Lump sum investing involves taking all the money you have available to invest and investing it all at once.
So lump sum investing is the fastest way to put all my money to work?
Exactly, but while it means all your money will be invested immediately, allowing for the potential to compound faster if markets rise, you're also risking all of it and leaving yourself more vulnerable to a market decline. So this may not be the best approach, especially during periods of volatility. Dollar cost averaging, on the other hand, involves spreading out your purchases, continually investing the same amount of money at regular intervals over a certain period of time. As a result, the total price you pay is less affected by market timing.
For example, if you have $1,000 to invest in a company that's trading at $50 per share, you could break it into 5 increments of $200 to purchase shares at regular intervals. Let's say you were able to purchase shares at $50, $48, $47, $51, and $52 over time. Your average price per share would be $49.60. On average, this saves you 40 cents per share compared with a $50 stock price if you had bought it all at once.
There are 3 key benefits to this dollar cost averaging approach. First, the psychological benefit of not risking the entire amount immediately and stressing out if the stock falls. Second, if the stock falls after your first purchase, you're losing a smaller amount. Third, buying over time can bring down your average cost per share if the stock drops.
Let's imagine that I invested that $1,000 in a diversified portfolio. Is there anything else I should consider?
You'll need to remember to regularly rebalance your portfolio, unless you've invested in a diversified mutual fund or an ETF, where the rebalancing may be done for you.
Of course. Let's say I invest my $1,000 in 4 companies, equal amounts of $250 in companies A, B, C, and D. If company A goes up in value more than the others, it will account for a larger portion of my portfolio.
Rebalancing would involve selling some shares of company A and buying more of companies B, C, and D.
Rebalancing is a great way to remove behavioral biases and ensure you are sticking to your investment plan. Remember, our emotions may discourage us from doing the right thing. It may feel counterintuitive to sell stocks that have gone up in value and buy more of stocks that have gone down. But it's important to do this to keep your portfolio on track.
It's particularly important to rebalance your allocation of stocks and bonds in a balanced portfolio. Otherwise, if stocks go up in value a lot, you may end up with a lot more exposure to stocks than you're comfortable with. And without rebalancing, this could lead to losing more money than you expect if stocks go down in value. And who enjoys losing money?
I know I don't.
I don't think anyone does. In fact, there's something called prospect theory that says that an investor's tolerance for risk is asymmetric.
Prospect theory, or loss aversion theory, suggests that, for investors, a loss hurts more than a gain of equal size feels good. For example, an investor might feel okay about making $10 but feel very badly about losing $10.
So investors are generally more likely to avoid losses than seek gains when the stakes are similar.
Exactly. Losses not only feel like they hurt more than gains feel good, but the larger the loss you experience, the more gain is required to recover that initial loss.
For example, if you have 10 marbles and you lose 5, you're left with 5 marbles. This represents losing 50% of your marbles. Now, if you want to get back to 10 marbles, you would need to increase the number of marbles you have by 100%.
Markets can go up and down like this all the time. In fact, there's a popular quote that says, "It's not about timing the market, it's about time in the market."
And what does that mean?
It means investors should be focused on investing for the long term to avoid pitfalls like taking on too much risk or gambling.
That makes sense. But what about investors who might play it too safe?
That's another pitfall. Investors who are focused on the long term and following their plan should avoid selling their investments when they are down and changing their portfolio after a downturn and making it too conservative.
So, let's recap what we discussed. Remember, it doesn't matter if you're a new or experienced investor, both can be prone to making investment mistakes.
Try not to make investment decisions based on emotions. Stick to logical decisions.
Unless you have a crystal ball, avoid trying to time the market.
After you've put together a diversified portfolio, remember to rebalance it back to its neutral mix.
Losses hurt more than gains feel good, and that can make them harder to recover from. Consider a dollar cost averaging approach to split up your purchases.
Try to create a plan that is suitable to you and avoid taking too much or too little risk with your investments.
And lastly, have fun with it.
Thanks for watching. Tune into our next video to learn more about investing.